Debt is a familiar part of modern life for many of us. We borrow for education, for a home, or to start a business. It feels like a simple transaction, a practical tool for getting by in a complex world. Yet, for millennia, the great religious traditions have looked at debt not just as a financial matter, but as a profound moral and spiritual issue. They saw it as something that could easily disrupt the delicate balance of a community. These ancient traditions understood that debt, especially when it involves high interest, has the power to create deep divisions between people. It can trap individuals and families in cycles of poverty, turning neighbors into masters and servants, and eroding the very fabric of society. The founders and prophets of our major faiths were deeply concerned with justice, compassion, and the well-being of the most vulnerable. They recognized that the accumulation of wealth in the hands of a few, often through lending money at interest, could lead to immense suffering for the many. This wasn't merely an economic observation, it was a spiritual one. They taught that a society where the poor are crushed by debt is a society that has lost its way, a community that has turned its back on divine principles of mercy and fairness. The scriptures and teachings of Christianity, Islam, and Buddhism all contain powerful warnings about the dangers of usury and the moral obligations that come with wealth. These religions did not just condemn exploitative practices, they offered a vision for a different kind of economy, one built on shared responsibility and mutual support. They imagined a world where financial relationships were guided by ethics, not just profit. This vision speaks of a sacred duty to care for one another, to ensure that everyone has the means to live a dignified life, free from the crushing weight of inescapable debt. The concern was always for the human person, for the community, and for the spiritual health that is impossible when people are in bondage. It is a timeless message that challenges us to look at our own economic systems and ask if they truly serve humanity. Today, as we navigate a global economy where debt is more pervasive than ever, these ancient religious perspectives are surprisingly relevant. They invite us to question the assumptions that underpin our modern financial world. Is it right that some profit from the misfortune of others? What are our responsibilities to those who are struggling financially? By exploring the deep wisdom of these traditions, we can find inspiration for creating more just and compassionate economic systems. We can rediscover the idea that an economy should be a tool for human flourishing, not a mechanism for creating inequality and despair. This exploration is not just an academic exercise, it is a search for a more humane way to live together. The Christian tradition has a long and complex history with the concept of debt and interest, rooted deeply in its ancient heritage. The Old Testament contains clear and repeated prohibitions against charging interest, a practice known as usury. In books like Exodus and Deuteronomy, the law is explicit. If you lend money to any of my people with you who is poor, you shall not be like a moneylender to him, and you shall not exact interest from him. This was not just a suggestion, it was a command intended to protect the poor and maintain social cohesion. The logic was simple and compassionate. A loan to a struggling neighbor should be an act of support, not an opportunity for profit. This principle was born from the understanding that a community's strength lies in its ability to care for its members. Charging interest to a fellow person in need was seen as taking advantage of their vulnerability, transforming a relationship of mutual aid into one of exploitation. The prophets, like Amos and Ezekiel, railed against those who grew rich through such practices, seeing it as a symptom of a society that had forgotten God's demand for justice and righteousness. The Bible paints a picture where economic exploitation is a spiritual failure, a betrayal of the covenant that binds the community together. This ethical framework placed the well-being of the person and the community far above the pursuit of individual financial gain. One of the most radical ideas in the Old Testament is the concept of the Jubilee. Described in the book of Leviticus, the Jubilee was to occur every 50 years. During this year, all debts were to be forgiven, and all land that had been sold was to be returned to its original family. This was a revolutionary social and economic reset button. It was designed to prevent the permanent concentration of wealth and land in the hands of a few powerful families. The Jubilee was a powerful statement that the land ultimately belongs to God, and no human has the right to permanently dispossess another. It was a mechanism to restore balance and ensure that poverty did not become an inherited, inescapable condition. In the New Testament, Jesus builds upon this tradition of economic justice. His famous parable of the unforgiving servant highlights the importance of mercy and forgiveness, especially in the context of debt. He teaches his followers to pray, "Forgive us our debts, as we also have forgiven our debtors." This prayer links divine forgiveness with human forgiveness, suggesting that our relationship with God is inseparable from our relationships with each other, including our financial ones. Early Christian communities took these teachings to heart, often pooling their resources and supporting one another to avoid the need for outside loans. For centuries, the Christian Church largely condemned usury, viewing it as a sin that preyed upon the poor and violated the core command to love one's neighbor. In Islam, the prohibition against charging and paying interest is one of the most central and defining principles of its economic ethics. This prohibition is known as the ban on riba. The Quran is unequivocal in its condemnation of riba, mentioning it in several passages, with the warnings growing sterner with each revelation. One of the final verses revealed to the Prophet Muhammad declares that those who engage in riba are in a state of war with God and his messenger. This is exceptionally strong language, placing the practice on par with the most serious of sins. It underscores that, in the Islamic worldview, economic activity is not separate from one's spiritual life. It is a core part of it. The prohibition of riba is not merely an arbitrary rule. It is rooted in a deep concern for social justice and compassion. The Arabic word riba literally means to increase or to grow, and it refers to any predetermined, guaranteed return on a loan, regardless of the outcome of the borrower's venture. Islamic teaching sees this as inherently exploitative. It allows the lender to profit without taking any risk or participating in the productive activity, while the borrower bears all the risk. If the borrower's business fails, they are still obligated to repay the principal plus the interest, which can lead to a devastating cycle of debt. The ban on riba aims to prevent this form of injustice and to foster an economy based on partnership and shared risk. Instead of interest-based lending, Islamic finance promotes a system based on equity and partnership. The core idea is that money should not be a commodity that is bought and sold for a profit. Instead, it should be a tool to facilitate real economic activity. Financial models like musharaka, which means partnership, and mudaraba, or profit sharing, are central to this vision. In a musharaka arrangement, the bank and the customer both contribute capital to a project and share the profits and losses according to a pre-agreed ratio. In a mudaraba contract, the bank provides the capital, and the customer provides the expertise, with profits shared between them. These models create a direct link between finance and the real economy. This ethical framework encourages a more responsible and productive use of capital. Because the financier shares in the risk, they have a strong incentive to carefully evaluate the projects they are funding and to support ventures that are likely to be successful and beneficial to society. This contrasts sharply with conventional lending, where a lender's primary concern is simply the borrower's ability to repay the loan with interest, regardless of how the money is used. The Islamic model seeks to create a symbiotic relationship where the success of the financier is tied to the success of the entrepreneur and the broader community. It is a powerful vision of an economy where wealth is generated through cooperation and shared enterprise, not through the exploitation of debt. Buddhism approaches the issue of debt not through divine commandments, but through its core teachings on suffering, attachment, and the path to liberation. The Buddha taught that the root of all suffering, or dukkha, is craving and attachment. From this perspective, debt is seen as a powerful form of bondage, a source of profound anxiety and stress that keeps the mind trapped in a state of constant worry. Being in debt creates a mental prison, preventing one from achieving the peace and clarity necessary for spiritual progress. The Buddha's advice on right livelihood, one of the components of the Noble Eightfold Path, emphasizes earning a living in a way that is ethical and does not cause harm to oneself or others. Accruing debt, especially for non-essential consumption, is seen as a form of unskillful living. The teachings encourage a life of simplicity and contentment, which naturally reduces the likelihood of falling into debt. In the Sigalovada Sutta, a text often called the layperson's code of conduct, the Buddha gives practical advice on financial management. He suggests dividing one's income into 4 parts: 1 for daily expenses, 2 for investing in one's business or craft, and 1 to be saved for times of need. This sensible counsel is a blueprint for financial stability and independence. It is a middle path approach to economics, avoiding both extreme asceticism and heedless indulgence. The goal is to create material security, not for its own sake, but to provide a stable foundation from which one can pursue spiritual development without the distraction of financial distress. Greed is identified in Buddhism as one of the 3 poisons of the mind, alongside hatred and delusion. The practice of charging exorbitant interest on loans is seen as a direct manifestation of this greed. It is an action that arises from a desire to profit from the hardship of others, thereby creating negative karma for the lender and immense suffering for the borrower. The Buddhist ideal is one of generosity, or dana, and compassion, or karuna. A loan, if given, should ideally be an act of help, free of interest. The emphasis is on interdependence, the understanding that we are all connected and that the well-being of one person affects the well-being of all. An economic system that systematically creates poverty and debt is seen as a source of collective suffering. While not as codified as the prohibitions in Christianity and Islam, the Buddhist worldview strongly supports community-based economic models that promote mutual support. In many traditional Buddhist societies, villages developed informal systems of lending and resource sharing that were built on trust and reciprocity. These systems functioned to ensure that no member of the community would be left destitute. The goal was to maintain social harmony and collective well-being, reflecting the deep understanding that individual liberation is intertwined with the health of the community. The Buddhist perspective reminds us that a truly wealthy life is not measured by material possessions, but by inner peace, freedom from attachment, and compassionate action in the world. Across history and cultures, while many religious traditions have condemned exploitative debt, some groups and systems have, tragically, perfected its use as a tool for power and control. When debt is untethered from ethical considerations, it really ceases to be a functional economic tool and instead becomes a weapon. This happens when lenders intentionally target the vulnerable, offering loans with impossibly high interest rates and opaque terms, fully aware that the borrower is unlikely to ever escape the debt. This practice, often called predatory lending, is not designed to help. It is designed to entrap. It creates a modern form of serfdom, where individuals and even entire communities become permanently indebted to a powerful lending class. This dynamic has played out on both a small and a large scale. At the micro level, we see it in the form of loan sharks who prey on low-income neighborhoods, or payday lenders who charge astronomical annual interest rates to those facing a temporary cash shortage. These practices create a devastating spiral. A small, manageable problem becomes a life-altering crisis as interest and fees pile up, leading to loss of property, bankruptcy, and immense psychological distress. The social fabric is torn apart as trust erodes and despair sets in. The community is weakened as its members are systematically drained of their resources, with wealth flowing from the hands of the many into the pockets of a few. On a macro level, the same principles of debt exploitation have been used between nations. In the 20th century, many newly independent countries in the global south took on large loans from wealthier nations and international financial institutions. While these loans were often presented as development aid, they came with conditions and interest rates that proved crippling. Economic downturns, falling commodity prices, or currency devaluations could make these debts impossible to repay. This led to what became known as the debt crisis, where poor countries were forced to spend more on servicing their debts than on health, education, and infrastructure for their own people, trapping them in a cycle of dependency. The societal impact of such systemic exploitation is honestly profound. It deepens inequality, creating a world of haves and have-nots where social mobility becomes nearly impossible for those at the bottom. It can fuel social unrest and political instability as people lose faith in systems they perceive as fundamentally unjust. This is precisely the outcome that the ancient religious traditions feared. They understood that a society built on the exploitation of the weak is not only immoral, but also inherently unstable. It plants the seeds of its own destruction by undermining the very principles of fairness, compassion, and shared humanity that are necessary for any society to thrive in the long run. In response to the ethical challenges of conventional banking, the principles of Islamic finance have moved from theory to a vibrant global industry. What began as a niche market has grown into a significant force in the world economy, offering a practical, large-scale alternative to interest-based systems. Islamic banks and financial institutions now operate in dozens of countries, managing trillions of dollars in assets. They offer a full range of services, including savings accounts, home financing, business loans, and investment funds, all structured to be compliant with the principles of Sharia, most notably the prohibition of riba. One of the most common products is the Islamic mortgage, which avoids interest through partnership models. For example, in a diminishing musharaka home financing plan, the bank and the customer buy a property together as partners. The customer lives in the house and pays the bank a monthly amount that consists of two parts: a rental payment for using the bank's share of the property and an additional amount to gradually buy out the bank's share. Over time, the customer's ownership stake increases while the bank's decreases until the customer owns the property outright. The bank's profit comes from the rent, which is tied to the real estate market, not from a predetermined interest rate. Beyond personal banking, Islamic finance is also making a major impact in the world of business and infrastructure development. Governments and corporations are increasingly turning to sukuk, often referred to as Islamic bonds, to raise capital for large-scale projects. Unlike conventional bonds, which are a debt obligation, a sukuk represents an ownership stake in a tangible asset or project. Investors who buy sukuk are not lending money. They are buying a share of an asset, and the return they get is a share of the profit generated by that asset, such as rental income from a building or tolls from a highway. This ensures that finance is directly linked to real, productive economic activity. The growth of Islamic finance demonstrates that it is possible to build a sophisticated and functional economic system without relying on interest. It provides a living example of an ethical framework being applied successfully in the modern world. While it is not without its own complexities and challenges, the Islamic finance industry serves as a powerful source of inspiration. It shows that the ancient religious call for an economy based on justice, partnership, and shared risk is not a utopian dream. It is a practical possibility that can be implemented on a global scale, offering a compelling alternative for those seeking a more equitable and stable financial system. Beyond the large-scale models of Islamic finance, another hopeful alternative is emerging at the grassroots level: community currencies. These are locally based systems of exchange designed to work alongside, not replace, national currencies. They are created and managed by local communities to achieve specific social and economic goals, such as keeping wealth within the community, supporting local businesses, and building stronger social connections. Also known as local currencies or complementary currencies, these systems are a powerful way for people to reclaim a degree of economic sovereignty and build resilience from the ground up, often operating on principles of mutual credit that avoid interest entirely. One well-known model is the time bank. In a time bank, the unit of currency is not a dollar or a pound, but an hour of a person's time. When a member provides 1 hour of service for another member, whether it's gardening, computer repair, or childcare, they earn one time credit. They can then spend that credit to receive an hour of service from someone else in the network. In this system, everyone's time is valued equally. The hour of a lawyer is worth the same as the hour of a babysitter. This model fosters a strong sense of community and reciprocity, valuing the skills and contributions of everyone, regardless of their status in the conventional economy. It is a system built on mutual support, not financial profit. Another powerful example is the LETS, or Local Exchange Trading System. LETS are non-profit community networks where members can trade goods and services using a locally created currency, often called green dollars or community credits. When a member makes a purchase from another member, their account is debited and the seller's account is credited. The system as a whole always balances to zero. There is no need for a central bank to issue money, and no interest is ever charged. This allows commerce to continue even when people lack conventional money. It encourages people to buy from their neighbors, strengthening local businesses and reducing the environmental impact of long-distance trade. These community-based systems embody the ethical spirit found in many religious traditions. They prioritize people over profit, cooperation over competition, and community well-being over individual accumulation. They are practical expressions of the idea that an economy should serve human needs and strengthen social bonds. By creating interest-free systems of exchange based on trust and mutual aid, these local initiatives offer a microcosm of a more just and compassionate economy. They remind us that we have the power to create financial systems that reflect our values and help us to care for one another, weaving a stronger, more resilient social fabric, one transaction at a time. A more radical and systemic alternative that has been gaining traction is the idea of sovereign money. This proposal addresses a fundamental, yet often overlooked aspect of our current financial system: the creation of money itself. Today, the vast majority of money in circulation is not created by central banks or governments, but by private commercial banks every time they issue a loan. This means our money supply is fundamentally a form of interest-bearing debt. The sovereign money movement argues that the power to create money should be returned to a public, accountable body, separating the process of money creation from the business of lending. Under a sovereign money system, a central bank or a similar public institution would be the sole entity responsible for creating new money, both physical and digital. This money would be debt-free and would be introduced into the economy to fund public spending, such as building infrastructure, funding healthcare, or providing a universal basic income. It could also be distributed to citizens directly. Private banks would continue to exist, but they would function more like intermediaries, lending out only the money they actually have on deposit, rather than creating new money out of thin air. This would fundamentally change the nature of banking, turning banks into true service providers rather than creators of the nation's money supply. The potential benefits of such a system are vast. By creating money debt-free, it could dramatically reduce the levels of both public and private debt that weigh down our society. Governments would no longer need to borrow from private markets and pay interest to fund their operations. This would free up enormous sums of public money for essential services. Furthermore, it would make the financial system much more stable. The boom and bust cycles that characterize our current economy are largely driven by the expansion and contraction of credit created by private banks. A sovereign money system would give public bodies more control over the money supply, allowing them to manage it for the good of the whole economy rather than for the profit of the banking sector. This idea, while it may seem modern, resonates deeply with the ancient religious warnings about the dangers of allowing private interests to control the means of exchange for profit. It reflects the principle that the basic building blocks of our society, including the money we use, should serve the common good. Proponents of sovereign money argue that it is a path toward a more just, stable, and democratic economy, It is a bold vision that challenges us to rethink the very foundations of our financial architecture, aiming to create a system where money serves humanity, rather than a system where humanity is in servitude to debt-based money. It is a powerful call to reclaim a vital public utility for the benefit of all. In exploring the perspectives of Christianity, Islam, and Buddhism on debt, we uncover a remarkable and powerful consensus. Despite their diverse theological foundations and cultural histories, these great traditions converge on a shared ethical vision. They all see the economy not as a separate, value-neutral domain, but as a deeply moral arena where our highest values of compassion, justice, and human dignity are either upheld or betrayed. They speak with one voice in their condemnation of exploitative lending, recognizing that charging interest on loans to the needy is a practice that erodes community, creates suffering, and violates a sacred duty to protect the vulnerable. This ancient wisdom offers a profound critique of our modern global financial system, which is built upon the very foundation of interest-bearing debt that these traditions warned against. The social and economic problems they foresaw, spiraling inequality, financial instability, and the entrapment of individuals and nations in cycles of debt, are the defining challenges of our time. The teachings on the Jubilee, the prohibition of riba, and the Buddhist emphasis on freedom from attachment are not relics of a bygone era. They are urgent and relevant messages that call us to question the fundamental justice of a system that allows wealth to be accumulated through the indebtedness of others. Yet these traditions offer more than just critique, they offer hope. They provide the moral and spiritual inspiration for building a different kind of world. The rise of practical alternatives like Islamic finance, community currencies, and bold new ideas like sovereign money demonstrates that this is not a mere fantasy. These models prove that it is possible to organize our economic lives around principles of partnership, shared risk, and mutual support. They show that finance can be a tool for creating shared prosperity and strengthening community bonds, rather than a mechanism for extraction and exploitation. They are living experiments in creating an economy that serves people, not the other way around. Ultimately, the message from the world's great religions is a call to re-infuse our economic life with compassion and a commitment to justice. It is a reminder that the well-being of the human person and the health of the community should be the ultimate measure of any economic system. As we face the complex challenges of the 21st century, we have a choice. We can continue down a path that generates immense wealth for a few at the cost of widespread precarity and debt, or we can draw on the deep wells of our spiritual heritage to build an economy that reflects our noblest aspirations. An economy where everyone has the opportunity to flourish, free from the bondage of unjust debt.